Hi, my name is Ray. Welcome to another episode of Ray's Economics Clue Book. Today, we're talking about part 2 of money creation and fractional reserve banking. Now, earlier we talked about how banks can increase the money supply because as all money is kept in the bank, and then some is kept as required reserve, other is loaned out or kept as excess reserves. And this loaned out money basically is either spent or saved, which eventually comes back towards the bank, another bank, and then it's kept loaned out the rest, and then it keeps going on in a cycle, such as very similar to how the money multiplier details changes in GDP from spending. This detail changes the money supply through banking and required reserve ratios. Now, we talked about last time, the Federal Reserve is basically the top-down function of banking. The Federal Reserve controls the sum of bank reserves and currency circulation, the monetary base. They can easily control the currency circulation and also money supply through their tactics of the discount rate, the required reserve rate, and also, of course, open market operations. And through these, they can basically increase or decrease or just affect on monetary supply. And so basically, we talk about the money multiplier as the ratio of the money supply to the monetary base, because it shows how through the required reserve ratio, banks can create more money by loaning out or spending their excess reserves, which could, of course, those funds theoretically all go back towards the bank or another bank, and then that bank keeps excess reserves from those deposits or funds, and then does the same thing to loan it out or spend it or etc. So that's the money multiplier. The size of the money multiplier, however, is reduced when funds are held as cash rather than checkable deposits, because checkable deposits can be kept in the bank, and then those funds can be kept as excess reserves, some of it at least, and then loaned back out. However, in the economy, not all the money goes into banks. A lot of money is just kept in the pockets of consumers. I mean, I can perfectly take a loan from a bank and keep all that cash under my mattress, and then not doing anything for it with it until I have to pay it back. And so that basically can decrease the money multiplier because that money is not going back towards another bank. It's not going in the cycle of banking and money creation. And so in reality, the money multiplier is smaller than bank reserves than what it is theoretically, because not all money is going back to the bank. A lot of money is kept as cash within consumer pockets and is not spent or nothing is done with it. And so as a result, it's just kind of not even in the system anymore, even though it's technically counted. And so the money multiplier is smaller than the bank reserves divided by the reserve ratio. We see here the monetary base, we have currency circulation divided by bank reserves, and the money supply is checkable bank deposits and currency circulation. And we see those two are overlap in currency circulation. And so a money multiplier is our funds, is basically our money supply overall over a monetary base, because it looks at how the banks create more money. But this is decreased overall when we keep money out of the banking system. So theoretically, if all money goes back to banks, then the perfect fractional reserving system, all excess reserves will be loaned out. Because banks can do three things with excess reserves. They can loan it out, they can spend it, which is similar basically, it has a similar effect basically on the money supply as loaning it out, or they can keep it as excess reserves, keep it as basically reserves, as insurance. And so if they keep it as insurance or reserves, this also decreases our money multiplier, because it increases our reserve ratio basically. And so in a perfect fractional reserve system, all excess reserves will be loaned out. All loans will be deposited as transactional accounts. They will not be kept as cash by consumers. So the money multiplier in this theoretical perfect situation will be 1 over R, 1 over reserve ratio. Why? This is basically the same thing as our money multiplier for a change in GDP, because it is a geometric sequence. We see you deposit $100. Out of the $100, $90 of that $100 is loaned back out, and out of that $90, another 9% is loaned back out as $81. So we have the money overall. We have $100 plus $90 plus $81, etc. We see our ratio is 0.9, so it's 1 over 1 minus 0.1 minus 1 over that, and so that is our geometric sequence. So it basically be 1 over our reserve ratio, 1 minus 1 over 0 minus 0.9, which is 1 over 0.1, which is our reserve ratio. And so, but however, this is theoretical. In the real world, money is kept either as excess reserves for the banks, or that is kept as currency by consumers. So in the real world, logically, you can probably see why this equation is true. The money multiplier is actually 1 plus the currency ratio, 1 plus the money held by consumers, over the R, reserve ratio, plus the E, the excess reserve ratio, because that is only held by banks, plus C, our currency ratio, is also held by consumers. Because this is all the money that's kept out of the hands of the people. And the rest is the money kept out of the hands of the money's multiplier system. The rest is kept in the hands of banks and then circulated throughout the economy as money in the money supply. So for our final clue, fractional reserve system allows for monetary creation because loans are considered new money in the money supply because they are creating new spending in a new cycle that goes back towards bank and then these banks loan it back out. But that only assumes that loans in their entirety are all deposited into transactional accounts through spending and then saving, and that none of it is kept as cash by consumers, and that no excess reserves are kept as basically reserves by banks. And so the central bank basically can determine a monetary base, because all circulated cash is basically Federal Reserve notes, and they are born from the central bank. And the central bank uses discount ratio and reserve ratio as two key tools to affect our monetary base and just our money in general. So thank you, and see you next time. Bye-bye.